I am Sammy Whited from the Tax Institute, and I'm here to tell you it is important to keep good records so that you are sure to get every deduction and credit that you are entitled to on your tax return. Good records are also important in the case of an audit by the IRS. There are a lot of court cases where business deductions were denied. Very often it is because there is no record of the deduction, not because the deduction is not valid. People and businesses often have expenses for travel, entertainment, and gifts. Good records, such as receipts and canceled checks, present the amounts and the dates of the expenses incurred. More information may be necessary to demonstrate that certain expenses are deductible. For example, some expenses, such as travel and entertainment expenses, must be further shown by records that establish the business purpose of the expenses. To deduct gambling losses, you will want to keep a log or a diary of gambling activities to show the date and the type of a gambling activity, the name and the address of the gambling establishment, and the amounts won or lost. You may want to keep all of your records in paper format. However, even if you use a software package or an accountant, you will still have some paper records. No matter what method of record keeping you choose, you should store your records in a safe place, such as a safety deposit box or a fireproof record box or cabinet. Also, be sure to back up and firewall your computer records. If you choose to use computer software, make sure you know how to use it properly. Remember, the output is only as good as what you put into the system. Employers must keep all employment tax records for at least 4 years after the tax is due or paid, whichever is later. You should keep your records for 6 years from the filing deadline for any tax year for income tax purposes.